With more than 6,000 small and micro-cap companies listed, if you're looking for the next apple at the earliest stage, then ChannelChek truly is the orchard. The listed companies support ChannelChek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for ChannelChek so you're always up to date on what's going on at the small and micro-cap data place. Welcome to the C-Suite series presented by ChannelChek and Noble Capital Markets. Noble is an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on ChannelChek. Today's interview features E.W. Scripps, NASDAQ ticker symbol SSP. Noble Senior Research Analyst Michael Kupinski interviews Scripps President and CEO Adam Symson and CFO Jason Combs. Visit channelchek.com or click the link in the description for Noble's research on E.W. Scripps, as well as news and advanced market data. And now, here's Michael, Adam, and Jason.
Adam and Jason, thank you for joining us today. I've been a big fan of the company's diversifications efforts, as you know, especially as you went into the OTT and OTA network platforms. The company made a bold move, in my view, to buy ION in the midst of a COVID crisis, of all things. When you look at the acquisition, how much does ION contribute from an advertising revenue growth opportunity compared with maybe you looking at it from a distribution platform for your OTT networks?
Mike, thanks for having us. The answer there is, I think it contributes in both ways, very materially. We expect ION to continue to grow, but we also recognize significant opportunity as we've brought together ION with what we used to refer to as the Cates networks, our legacy networks, in order for us to actually transition those networks off of leased spectrum in the over-the-air space onto our own spectrum. And we expect to see growth across all of our networks, really. That growth will come from a couple of different levers. First is the marketplace's growth. We expect to see over the air as a distribution mechanism continue to get more and more consumer adoption. We've also already seen the impact of bundling our networks together in the upfronts and in the scatter market, as we've brought more networks to advertisers for them to reach the key demographics they're trying to get after. And what we've also seen is that the upfronts really validated our thesis behind over-the-air broadcast networks being a key way agencies and advertisers can reach cord cutters. Remember that those folks aren't subscribing to cable anymore, and so these brands and agencies are looking to new ways to reach them with television advertising. They are plugging in digital antennas. They are watching our over-the-air networks, and so we become a greater component or a more important component of their advertising mix. So we see revenue growth ahead in general for the Scripps networks on a couple of fronts. Obviously, we think we'll continue to see the growth in the over-the-air marketplace. We'll continue to see opportunity as a result of sales execution. We'll continue to expand upon our leadership position. We've done just that, now launching 3 additional over-the-air networks, TrueReal, Defy, and Newsy over-the-air. And we'll continue to expand our existing brands and new ones into the connect television space as we yield the benefits of the growth of free ad-supporting television as well.
And Adam, you're obviously enthusiastic about the OTA market. How big do you expect that market to get with so much viewing, fragmentation, and so forth?
Look, I think that we're going to continue to see consumers cut the cord. It's just a reality. I think when they do so, they'll continue to bundle together a la carte offerings like subscription video on demand services like Hulu and Netflix, general services. I think they're going to add on niche services like Discovery Plus and ESPN Plus and Disney Plus, and then they're going to be struck by how much money they're paying in all of these disparate bills. And the beauty of free over-the-air television is essentially it's free and it's easy. Today, between 30 and 40% of US households are leveraging a digital antenna to supplement their SVOD services with free network television, and we expect to continue to see that grow as consumers recognize that free is certainly a compelling consumer proposition.
Well, congratulations to you for recognizing early the movement towards OTC, OTT, and OTA marketplace. The company has indicated that it anticipates continued margin expansion in the new Scripps Networks division, driven by revenue growth of 10% plus per year. How much of that 10% plus revenue growth will come from adding new networks, or is that organic growth from the current existing networks that you have? You mentioned a couple that you just recently launched. And then outside of your recently launched networks, what are your plans beyond Defy and True TV and Newsy and Court TV, for instance?
When we acquired ION and we did the modeling internally ourselves and then ultimately shared with the street our expectations, we did not even contemplate, I think, the opportunity for us to launch additional networks. And those additional networks that I referenced, those networks are really going to take some time for that revenue to become material and for that revenue to, I think, be reflected in growth. So when we're talking about the growth we expect from the networks division, we're really talking organically from the networks that we have in our portfolio already, before we think about adding on additional networks or leveraging our leadership position and expanding upon it. Beyond the first 3 networks that we've launched, I think our focus right now is identifying the best and highest use for these programming streams. So I wouldn't expect us necessarily to be out with any announcements about launching new OTA programming streams. I do think we have additional opportunity to take the programming streams that we run today over the air and to move them into OTT services, like the free ad-supported television services that also are growing just as quickly alongside OTA. Jason, I don't know if you want to quantify that at all, but that's to me the sort of strategy behind the growth levers that we expect in the network side of things.
No, I think you hit the nail on the head. In the short term, it's a very small percentage of our growth, which is driven by the launch of these 3 new networks. But through yield optimization, through revenue yield, we really have a chance to drive drive the majority of that 10% plus growth per year in the short term. But we wouldn't be launching these networks now if we didn't think that down the road there's some really meaningful revenue that these 3 new networks will generate.
Right. And Adam, you mentioned Newsy, and I think Newsy transitions over the air this weekend with plans to reach about 92% of the U.S. households. Why was it necessary to take Newsy off cable systems in order to launch it over the air?
Well, we were reaching between 30 and 40 million homes in cable, which, in and of itself is a shrinking marketplace, a shrinking universe. And we had the opportunity, given our ownership of all of that spectrum after the ION transaction, to be able to really accelerate Newsy as a brand and reach 92% of US homes right off the bat. And so for us, it was a math problem. Where would we find the greatest opportunity for us to power Newsy's success forward? And as you know, the cable operators, they're not keen on carrying content which is also available for free over the air or on OTT. And so we had to make the decision to pull our product off of cable. We've meanwhile really upgraded the talent. I think we've really focused a lot on some research where we see the opportunity for us in the over-the-air and the OTT space, both with younger and I think more advertiser-friendly demographics. And I expect this move will really reap the rewards for Newsy and for our networks business in general.
Recently, the company made an investment into esports, which is a dynamic growth industry that I happen to follow. Historically, the company has been very entrepreneurial in making investments that pay off handsomely, like cable networks, podcasting, and the like. Is this investment a toe in the water for something larger, a step in the direction of a more developed business opportunity, or simply a local programming decision?
No, I mean, look, we spend a lot of time thinking about where the media consumer is headed. And young people today are spending a lot of their time not necessarily watching the television screen, but interacting with that television screen either by participating in gaming or by participating in esports as a spectator sport. And so we felt like it was a good opportunity for us to get inside, better understand the ecosystem with a small $10 million investment into Misfit Games. that also comes for us with some commercial opportunity. The beauty of Misfit Gaming was that the franchise teams that they own operate in Florida. And Mike, you know, we have a very deep portfolio of television stations and OTT properties in Florida. And so we got together with the folks at Misfit and could see some natural synergy opportunities for us to work together that we thought would provide commercial opportunity to our Florida operations and provide us with the strategic opportunity to make that investment and follow along a very immature but fast-growing marketplace.
Well, I applaud your interest in esports. As you know, I cover that industry, and in launching coverage of companies in that space, I learned that some of those demographic groups that you mentioned that are gamers spend more time gaming than watching TV. And if video games were rated like TV stations, there would be more people gaming than watching some popular TV shows. So I think it's very smart of you to make that investment. I know that you plan to launch esports programming on your local digital channels, but do you see the opportunity to launch an esports channel as an OTT network? Could you explain the prospect of a much broader programming aspect here?
I think we'll probably look at any and all opportunities. The question we'll have to ask ourselves is, where are those consumers looking for that kind of content? And where is our opportunity to work together with the team at Misfits to create greater value? So for us, I think right now we've just gotten into this. As I said, I think our first focus will be on working together with the folks at Misfits to ensure we're good stewards of our investment and of the business, but also in assessing the commercial opportunities to leverage our Florida-wide footprint and their Florida franchises to bring commercial value to both entities.
Gotcha. And I kind of want to switch over to the retrans side of the business. Of course, that's one of your key growth drivers. Can you just talk a little bit about when the Comcast subs come up for renewal? It seems that the company left a lot of money on the table in the last round. And I know that you've mentioned that 75% of your households come up for renewal in 2023. So can you talk a little bit about the outlook for retransmission revenue growth going forward, maybe over the next couple of years?
Yeah, so looking backwards, if you recall, we renewed a significant portion of our subscribers last year in 2020. As we look forward, we have a pretty small amount this year that are renewing, about 21% next year, and then, as you alluded to, Mike, about 75% renewing in 2023. So if you think of the kind of the top line revenue growth, this year we have some moderate growth because we're cycling past some mid-year renewals from 2020. We'll have kind of muted growth in 2022, and then we look for a pretty nice step up in 2023 as we renew again 75%. And one of the nice things as we look forward is that from a network affiliation perspective, all of our network affiliation agreements come up by the middle of next year. So we'll have already negotiated those, we'll have laid in our expense base and be very well informed as we look towards those negotiations in 2023 to ensure that from our perspective, we're getting market rates and we're driving net retrans margin expansion in 2023.
Yeah, I'll add also that relative to negotiation strategy, I would say, the Scripps of the past was a very different scaled broadcast company with many fewer stations, right? So we really leveraged our balance sheet in order to significantly expand the scale and reach of our local media portfolio. We did that ahead of 2020 when we knew we were going to be negotiating a big chunk of our retrans renewals. And I think the proof is in the pudding. I mean, I think what we ended up with in 2020 was rates that didn't leave anything on the table. And I would expect this company, as we move over the next couple of years, to take the same aggressive approach to negotiating with the MVPDs to ensure maximizing the value of our distribution.
Gotcha. And Jason, just coming back to your comments, given the fact that you have an increase in network comp next year, you're looking for more modest growth in retrans revenue. Does gross retrans, is that likely to go up next year, or do you think it might be down a little bit just because of the increase in network comp?
I think if you're talking in terms of margin, we may see a bit of a headwind there in margin, but I look at this not 1 year at a time in terms of retrans. I look at 2-3 year cycles, and the fact that we've shown margin expansion as we look from 2018 to where we're at today, and as we look forward to 2023.
And I think retrans has been a key growth driver to the industry, obviously, and unlike many in the industry, you still have a significant retrans growth opportunity ahead of you. We talked a little bit about 2023. But what seems to worry investors is the sustainability of the retrans as a growth driver, I think, given subscriber losses at MVPDs and consumers see a plethora of program choices and connected TVs and OTT and even FAST. For our viewers, FAST is free ad-supported streaming television, which Adam mentioned earlier. You explained earlier how Scripps is well positioned for the consumer to shift to these platforms, which is very unique to Scripps. But is there a growth story left for television outside of retrans and political advertising? Let's add that. Are there advertising categories that are meaningful in terms of revenue growth? Are there spectrum opportunities that provide another revenue stream? Do you believe that the new broadcast standard offers growth opportunities? Or should investors just view television simply as a mature business that throws off a lot of cash flow, like yourself? And then how do you allocate capital into other growth areas? I was just wondering broadly your feeling about the television industry.
Well, let me focus on local television, because remember, our company now really has two divisions, and I think the story is a little bit different with respect to margins and growth opportunity on the national side, the national network side, compared to the local side. First of all, on the local side, I would tell you, last year we witnessed a pretty substantial decline in core revenue when the quarantines and the onset of the pandemic took hold. And there were a lot of people that thought, well, we're never going to see a return to 2019 core revenue numbers. And in fact, we have seen a return to 2019 core revenue numbers. I think the industry is right back there where it was. And that's pretty remarkable. And I think that's a testament to the power of local television, the strength of our local brands, the importance of our product to the local communities where we operate, and frankly, that there's still a relative moat around what we do in the local marketplace. We've seen some very strong categories come back this year: home services, legal. We've seen new categories pop up and go from basically nothing to something very significant, sports betting as an example. And we've seen a return essentially to 2019 spending levels on core advertising, and we haven't even yet captured the return of travel and leisure. So I do see significant opportunity with the fundamentals ahead. I also continue to see opportunity with retrans, as we just talked about, and we shouldn't discount the value and the importance of political, because 2022 is going to be a significant year for political spending. We're already beginning to see spending early on. We've certainly, I think, brought in more money in this year than we thought we would. And we've seen the fundraising at a fevered pitch as the two political parties really go at it to try and battle it out for the governor's mansions across the country and the evenly divided Senate as they think about moving forward. And I think local television will be the biggest recipient of those dollars. So there does tend to be sort of an obsession with tracking core revenue. But I would remind us that the business now has multiple revenue streams, and I think the fundamentals are very sound. Despite even that conversation and my faith in the fundamentals on the local side, the thing that differentiates us as a company is, whereas our peers are really consolidated in that one marketplace, we have two marketplaces. We have our local marketplace, which I just described, and then we of course have our national marketplace, which we've described having growth in the mid-teens and having margins, around 40%, and that we expect margin expansion as we continue to see opportunity for us to play a larger and larger role in people's network television opportunity. So I feel very good about the fundamentals in linear television as it stands. Yes, we'll continue to see some pressure in cord cutting, and that pressure will result obviously in lower subs. But what you get with this company is the opportunity to have your cake and eat it too. A growth story on retrans as a result of repricing, and the ultimate hedge, essentially leadership in the over-the-air network business, expansion on multiple platforms like OTT, connected television, and the FAST platforms, and the continued growth of that entire marketplace over the air around our leadership position.
And Adam, do you think that the use of the spectrum, whether it be for autonomous cars or maybe geo-targeting or with the new broadcast streaming, broadcast standard, do you think that there's streaming opportunities, other opportunities there, or is that just too far out into the future that you just really don't think that investors need to pay much attention to at this point?
Look, I think the nearest term opportunity is going to be identifying ways for us to make television a more compelling proposition. And some of that's just going to be natural, as the ATSC 3.0 standard allows us to broadcast in 4K ultra high definition with immersive sound. I do think there are some catalysts ahead that will provide opportunity for consumers, and that will lead to potential incremental revenue opportunity for companies like Scripps. So for example, we know how important sports betting is, and most sports betting is happening within games. So if you're watching on a virtual MVPD, a streaming platform, you're actually watching a delayed stream. So you're not actually seeing a real-time stream, which is really only available through broadcast. One of the things we're looking at is how does ATSC 3.0 and that real-time stream become interactive and allow for greater opportunity for the consumer to interact with the content through betting applications. That's one opportunity. Another opportunity we're thinking about is ways that we can think of ATSC 3.0 as a closed system. So transmitting data and providing a receive opportunity inside autonomous vehicles for very efficient firmware updates, for example, or traffic updates, smart cities, connected homes. So there's a lot of opportunity for us to use our efficient one-to-many transmission. That's the stuff that's a little bit further out. One thing I do think we'll get to the opportunity to have a back channel for broadcast television that will open up an opportunity for more data-informed advertising. And when you're able to control your inventory and leverage data against it, you're ultimately able to enhance yield and raise CPMs. So I think investors should start pushing our companies within the next 3 or 4 years to better understand how the data we have about our consumer is informing our yield and our advertising opportunity. But even that's, I would say 3-4 years out.
You mentioned about the political. You made a pretty bold statement in previous investor calls that you think that political will be more than 265 million, and of course, political carries very high margins. In the 90% range. So the cash flow is going to be significant. First, do you continue to have confidence in that guidance, and do you worry that other platforms like digital will start to gain prominence as we go into 2022?
I'm very confident in those numbers that we've shared. I absolutely believe we're going to see a significant amount of political revenue next year. You're right, it's very high margin revenue. I'm not particularly worried right now about the take on the digital side of things for a couple reasons. One, I think Facebook and Google will be in the political business, but those platforms have essentially proven themselves out to be better suited for fundraising, and they've done that in past cycles, and I think they'll continue to do that. When it comes to changing hearts and minds, when it comes to motivating likely voters, local broadcast television continues to be the most effective platform. And I think consumers or investors can look at political cycles as ways to gauge the efficacy of the medium. And you can see that these political campaigns treat the political cycles and their buys in television like the greatest going out of business sales around, right? They have no reason to hold on to any money past that election day, and they spend without abandon on local television to ensure that they're putting their best foot forward to get their candidates into office. And I expect we'll see that next year, just like we have in the past.
You mentioned Google and Facebook, and obviously Facebook has kind of stumbled here a little bit with their conversion data, given that Apple is kind of now, not providing, well, consumers are opting not to be tracked, and so they don't have the tracking data that they used to have. And so conversion data is kind of faltering for Facebook. Some executives have said that this kind of levels the playing field for some traditional media companies. And I was just wondering, first of all, if you agree with that, if you do think that there is an opportunity for you to capitalize on this the lack of conversion data that Facebook has, and if you are actually using it now to kind of increase your sales presence against Facebook?
I actually think there are a lot of things that have happened over the last year or two that have benefited our marketplace. I think brands are looking for brand safe environments. And I think they've seen a lot of reasons to give them pause over the last 2 years with respect to their content, their advertisements being shown on platforms like YouTube or Facebook around content that they wouldn't necessarily want their brands associated with. I think the growth of search and of Facebook hasn't changed really the reality that television and the 30-second spot remains the best way to tell a story. I have yet to see a search term or a Facebook ad that can inspire somebody to go out and change their mind about a brand, or to feel an affinity as strongly as we all remember feeling around, McDonald's campaign, or You Deserve a Break Today, or the Subaru Love campaign. These are campaigns meant to inspire people to take action and to make us feel something. And you just don't get that from other mediums aside from television. So I'm very confident with what we're seeing. I think they'll continue to play a role, of course, in the marketplace. They are a dominant player, but I think for us, agencies and marketers, chief marketing officers are recognizing that linear television is the most effective way to help them build brands. We may not be lead gen, so to speak, but I definitely think when it comes to building a brand and getting the cash register ring, the CMOs still turn and will continue to turn to television.
And Adam, you stepped on the pedal and made a significant number of acquisitions in quick succession, and debt levels lifted meaningfully, well above historic norms. And to your credit, debt has been significantly reduced, and a large factor has been because of improving cash flow, and your free cash flow conversion has increased to 50% plus. So can you talk a little bit about the debt reduction, where you would like for debt to be, and then talk about your free cash flow and maybe capital allocation?
Yeah, Jason can talk a little bit about that, but I would just remind investors the premise of our use of that capital to expand our business was essentially for us to enhance the cash flow production of our business, to make our business more durable. And so, we knew we were going to be levered a little bit more, but we did so because we knew it would put us in a much better position in a go-forward basis. Jason, why don't you talk about the specifics of Mike's questions?
Yeah, so certainly, as Adam alluded to, we did the acquisition because we want to build a bigger, more robust cash flow profile. We did lever up as a result, and at the end of Q2, we were sitting at 4.7 times. Historically, we've been more in the 3.5 time range or so. Good news is, on a couple fronts, first of all, the 4.7 times at the end of the second quarter was better than we would have anticipated coming into the year. And that's really on the back of the really strong performance we've seen year to date, and the rebound we've seen in the ad market, and the success so far in the ION integration. So we're happy to be there at the end of Q2. We also did pay down $450 million in debt in the second quarter, so really quick progress there, and we intend to make additional pay downs in Q3 and Q4 on our way back down to that mid 3 times range. And as I look forward to next year, I think we'll certainly be in the low 4s in 2022.
Right, and so I'm just wondering, so the plan is to get down to the mid 3s. You said that you're going to be in the low 4s in 2022. Do you feel more comfortable now, having gone through this experience of improving the profile and the cash flow profile of the company, to have a little bit higher debt leverage? Do you think that acquisitions are likely as we go into 2022? And if so, what kind of areas of interest do you have, given that you're pretty much at full complement, I believe, at a lot of what you can do on the TV side?
Look, I think we've said that our primary use of capital right now is to continue that debt pay down. Nope, I think our comfort zone of being around 3.5 remains our comfort zone. We are willing to stretch our balance sheet to be opportunistic when we see an opportunity that makes us better, improves the fundamentals. I think that could be true again if something were to come up that made sense for us. But I wouldn't assume that is our strategy. We're really focused on leveraging that additional free cash flow to pay down debt. I guess I'll leave it at that.
And I know that in the past you've had some share repurchase programs and so forth, which have kind of been suspended given that your debt leverage went a little higher than norm. What are the opportunities of maybe doing a stock buyback, or what lever at what point would you like to see leverage before you might consider looking at stock repurchases?
So based on the Berkshire Hathaway financing that we entered into, that deal is what precludes us from either issuing dividends or stock buyback. So we're precluded from that while the instrument is outstanding. It's a 5-year term, no call term. So at this point, it all leads back to what Adam said. Right now, our short-term focus is on using our free cash flow profile to grow or to pay down debt. And continue also to focus on growing the business and growing that free cash flow conversion. I
had to ask the question. So, Adam, I was wondering, are you surprised that the stock is down? It's roughly down like 23% from its highs in March, given that you've seen this rebound, not in advertising, not just like you had mentioned, your core advertising is near 2019 levels. You've had this significant debt reduction, in the second quarter, you just mentioned over 400 million. And the fact that we're closer today to the influx of political advertising than we were in March. The stock appears to be trading at near a 30% free cash flow yield by my calculation. Why do you think that the stock has drifted?
Yeah, there's definitely some inefficiencies in the market right now relative to our stock. I'm not sure if those are tied to investor sentiment around the sector, not necessarily recognizing the two sides of our house and the growth story and how that comes together for us. I would tell you, our company right now stands with several major catalysts ahead, and it appears to me to be very undervalued. I mean, on the one hand, we have 2022 that's going to deliver significant high margin revenue in political in the midst of this rebound in the economy, where, as I said, we're already essentially back to 2019 levels. So that's catalyst number one. Catalyst number two, a year later in 2023, we'll be repricing 75% of our subs. So again, another opportunity to see performance improvement. And then catalyst number three really is the Scripps Networks business and the opportunity we have to continue to see a business in the media space with a 40% plus margin, with expected margin expansion and revenue growth in the mid-teens range. To me, those are three catalysts that when you do the math, and the analysts like yourself certainly have with price targets, upwards of, even $30. You see us trading where we are today. I agree. I am surprised by it. Nobody's really been able to give me the exact answer as to why, but it's certainly a buying opportunity for investors that understand our story and our long-standing view of value creation.
Well, I happen to be at a $32 price target. So with that, I can't think of ending at a better high note than that. I'd like to thank Adam and thank you, Jason, for joining me today. I would encourage our viewers to check out my latest report on Scripps. The stock symbol is SSP. You have free access to all of my Scripps reports on channelchek.com. And with that, thank you again. Thanks, guys.
Thanks so much, Mike.
Thank you, Mike.
Thank you for joining us for this C-Suite interview presentation brought to you by ChannelChek. Visit our YouTube channel for more interview content, as well as virtual roadshows and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and the 6,000 other small and micro-cap companies listed.